Hey guys, it's Brian. Welcome to Financial Fitness. If you're new to the channel, please subscribe. In this video, I'm going to talk about my opinion on investing in real estate property and why I'm not a fan of it, along with some pros and cons of investing in real estate. Let's get started. So my opinion of investing in real estate to build wealth is that there are just too many cons and barriers to entry that make it difficult to invest in either commercial or residential property. I'll focus more on residential properties since that's going to be more familiar to most people. And so the main reason, in my opinion, is going to be fairly obvious, and that is the costs involved with investing in real estate. That includes saving up for a down payment, paying for a property all in cash, or the ongoing maintenance costs and insurance costs. So if you think about how long it takes to save up for a down payment, it would explain why the average age of people buying their first home has increased in recent years, and that home values have been rising, making it more difficult to afford a mortgage. The average age of a first-time home buyer in 2018 was 32, but back in the 1970s and 80s it was 29. This is because of home values rising, wages mostly staying flat, and people wanting flexibility to move depending on their career progression in their 20s and 30s. So let's assume you end up purchasing a second home as an investment. Then you only have two ways of making money from it. The first way is to rent it out and depreciate the maintenance and improvement costs as a tax benefit, and basically have the renters cover the monthly costs of the home besides what you put down for a mortgage payment. There are some challenges to this, primarily that it is already challenging to pay for somewhere to live currently through renting while still saving up for a down payment on your first home. So not only do you have to have somewhere to live initially before you buy your first home, then you have to save up enough to get a second one as an investment. That's a lot of pressure on your cash flow, even if you skip straight into a multifamily home instead of buying two single-family homes. With a multifamily home strategy, you can live in one unit and rent out the other units and still have positive cash flow each month. But that's just not like a single-family home. Ideally, having at least 3 units and living in one of the 3 provides a more optimal positive cash flow. At that point, it's like living in an apartment building almost, where another unit can impact you if there are leaks, damages, or noise, complaints knowing that you're the landlord and you live right next door, upstairs, or downstairs. It's just not an ideal situation going with either 2 single-family homes because of the costs involved, or 1 multifamily home and sacrificing some privacy as a trade-off for lower costs. You also need the consistent income to be approved for and to support multiple mortgages. This is not realistic for many people to support 2 mortgages on a single family or multifamily home or apartment of probably about $200,000 or $300,000 each, or more potentially if you live in a big city. The median home value in the United States has increased to $231,000 as of 2019, up from $111,000 in 1999, which shows an increase of over 100%. If you invest in a single-family home, you'll be more or less at a wash or flat in terms of cash flow until the mortgage is paid off. So then, at that point, I'm not quite sure why you'd bother in the first place. So if your tenant decides to leave, or you potentially need to evict your tenant, then you need to cover the mortgage payments again until you find a new tenant. If you have a multifamily home, it's not as likely that all your tenants would not be able to make their rent payments at the same time, but it's also a possible scenario. Keep in mind that landlord-tenant laws generally favor tenants, which makes it harder to evict any potential bad tenants. Between dealing with tenants that leave on their own, tenants that you might need to evict, tenants that could cause damage to your property, and could be needy in other ways, it may be easier to pay a property manager to deal with things. But wait, then you're likely at a loss of cash flow unless you rent out at least 2 properties or more, which defeats the whole purpose of the investment property. Honestly, from this standpoint, from the lost time finding good tenants or replacing old tenants, relying on good tenants that pay on time, hoping your tenants don't damage your property, actually maintaining the property, other maintenance costs, property taxes, and insurance, I can't understand why this seems like a good idea, especially for millennials. When you're just starting to build wealth and you take a large portion of that to do something that may not increase substantially in value in the future, takes away cash flow up front, has a lot of associated costs, and you may or may not even be living there, the pros just don't really seem to add up. I'm skeptical also that the tax deduction you can take to depreciate the home based on improvement costs and purchase price over the 27.5 years balances out the unbalanced cash flow until after the mortgage is paid off. Renting out an investment property offers a very, very long-term benefit, over 20 years or more in the future. This idea of renting out property seems very popular, but it's not that great for positive cash flow in the near term or growing wealth through real estate prices increasing in the future. Home values have somewhat peaked with little room for growth now that wages have not increased enough for people to keep affording homes that have been steadily increasing in price. And since you cannot depreciate the actual land and only the property itself, that's one more thing to think about. At that point, it'd be best to have an accountant determine the best method of depreciating your rental property, or whether a cost segregation to depreciate certain parts of a home faster or slower than others would make sense for your taxes. Cost segregation usually only makes sense when managing multiple investment rental properties. What I'm getting at is that there are a lot of costs and risks involved with real estate, and in my opinion, a lot of hassle. Some people may see the hassle as an opportunity, and that's perfectly fine if you can make it work. Just know what you're getting into first. Up to this point, I've only talked about renting out property to provide the cash flow to offset the mortgage payments and other costs associated with buying and maintaining an investment property through having tenants. But the second way to make money on real estate property would be through house flipping. If real estate prices are increasing rapidly, potentially just buying and holding for a small period of time before selling can result in a profit too. Normally, house flipping is defined as buying a home as an investment and renovating it to some degree to add additional value, and then putting it right back on the market and selling it at a profit above the purchase price and renovation costs. House flipping requires a lot more money, so you can do some quick renovations and maybe even serious ones, depending on the condition of the home, to turn a bigger profit. In many instances, buying homes for house flipping can either be done as cash offers or still through mortgages to save cash upfront for renovating and adding additional value to the home price. Either way, house flipping needs to happen on a fairly short schedule, usually within a month or two, to limit the amount of bills and mortgage payments on the house during the renovation period before the actual flip and selling it to make the profit. This is the more interesting of the two options to make money on real estate, but it does come with some other drawbacks. And those would be things like buying houses for flipping usually means buying homes that sometimes need a lot of work in order to buy it at a low price to increase the potential profit from renovations. This could lead to discovering all kinds of additional problems like plumbing issues, electrical issues, repairing walls, roof repairs, changing the floor plan, and so on, that could impact your potential profit. So here's what it comes down to. If you're trying to become a landlord and collect monthly rental income, you're probably trying to generate additional cash flow for yourself and generally trying to increase your wealth over time, as the property may increase in value, and to depreciate the value of the investment property to take advantage of the tax benefit. If you're trying to flip houses, you can run into a lot of issues and costs trying to both renovate and finish quickly to keep costs down and make a profit faster. Essentially, if you are able to flip real estate, you probably already have a substantial net worth, and flipping real estate will just help you increase it further and faster. If you're trying to collect rental income, it's not really going to help you that much, at least not until the mortgage is paid off and you're finally putting the rent payments in your pocket instead of into the mortgage, or you have multiple units being rented out. The other upfront benefit is depreciating the home for your tax returns. There are still taxes to be paid on the rental income too, just like there is when flipping a house for a profit. Both are taxed at income, except that not all of the rental income is necessarily taxable based on the depreciation. The taxable portion is determined by how much is subtracted for expenses that get your property ready to rent and then to maintain it. Either way, they're both challenging to make money or turn a profit from, and you have to think about whether you have ways to either manage any rental properties efficiently and effectively without it taking up too much time, or do you have the money necessary to flip houses and keep renovation costs low while renovating quickly. I don't like either choice, which is why I choose not to invest in real estate. Maybe at some point in the future, I'd try flipping real estate, but it's not likely. To sum this up, here are the pros and cons of investing in an investment property. Pros: with lower interest rates, which is anything lower than 4.5%, on mortgages, it might be possible to afford a higher priced investment property than normal. Renting or keeping and holding, generally real estate is more likely to increase in value over a very long period of time than decrease in value. Renting may provide some tax benefits through depreciation if renting out the investment property to tenants. Renting can provide a mix of positive cash flow in the near term and appreciation over a long period of time. Flipping, potential to be able to make a profit relatively fast through quick renovations. Cons: the initial cost and use of savings for a down payment is a significant barrier to entry. Need consistent income to be approved for potentially multiple mortgages. For renting, dependent on good tenants that don't damage your property to offset mortgage payments, upfront costs, and ongoing costs. Flipping, renovation costs or repairs and maintenance can add up fast. Largely, whether renting or flipping real estate, it requires money to make money, not a liquid asset, which makes it hard to convert to cash quickly if needed. But another option to invest in real estate is to invest in REITs, or real estate investment trusts, which give investors a way to invest in real estate without having to own, operate, or finance properties themselves. REITs have a ticker symbol just like stocks and ETFs. REITs are required to distribute at least 90% of their taxable income to shareholders to be considered a REIT and get beneficial tax treatment. This means that for shareholders, the dividends are often higher than most individual stock dividends. There are also two types of REITs: equity REITs and mortgage REITs. Equity REITs generate income through the collection of rent and from sales of the properties they own for the long term. Mortgage REITs earn income from the interest on income producing real estate. They purchase or originate mortgages along with mortgage-backed securities. Here are the key points of REITs. REITs are companies that own, operate, or finance income-producing properties. Equity REITs generate revenue primarily through the rental income on properties they own and operate. Mortgage REITs generate revenue through interest income by investing in mortgages and mortgage-backed securities. In general, equity REITs might be good for long-term buy and hold investors looking for a combination of growth and income. Mortgage REITs are better suited for investors looking for maximum income without focusing on appreciation. It just depends on what works better for your portfolio and what financial goals you're working towards. REITs are another option to consider for diversifying your portfolio. So this is not to say you can't make money by investing in real estate, because plenty of people have made a really good living doing so in the past. But I just don't think you can make as much money by buying real estate as many people have historically, because real estate prices aren't increasing as rapidly anymore. Investing the money that otherwise would have gone towards an investment property and instead into dividend stocks and collecting dividends passively is generally a more reliable route towards passive income, along with a small amount of potential growth. Alternatively, instead of investing in real estate, you can always become a real estate agent and make money on commissions by facilitating real estate transactions or listing properties. That's my opinion on real estate investing overall. I'm not wild about it, but we do have to live somewhere, and I do think that buying your own home is important and a lower cost of living compared to forever renting. Let me know your thoughts on real estate investing and if I made an impact on your opinion. Thanks so much for watching. I hope you liked this video and found it insightful. Click the like button if you did, and please subscribe if you haven't already. Click the notification bell so you can see when I post videos next. Feel free to leave comments, questions, and any topics you might want to hear about in future videos to get on track to being financially fit. See you in the next video.